Hello, this is RSM336 video assignment presented by Danlu Chen, and it's my pleasure to introduce my investment philosophy and the financial topic that I'm interested in next 4 to 5 minutes. To begin with, I would like to introduce my investment philosophy. My point is to focus on long-term horizon and greater financial returns. Based on this philosophy, I would like to choose the strategy of passive investing. Especially for index fund investing. By definition, as you can see, passive investment refers to a buy and hold portfolio strategy for long-term investing horizons with minimal trading in stock market. Passive managers is the opposite of active management, in which a manager selects stocks and other securities to include the portfolio. According to data, Sharpe Ratio concluded that active fund managers underperform passive fund managers as a whole. So the reason why I choose passive investing, first is because diversification. Maintaining a well-diversified portfolio is important for successful investing, and passive investing via index is an excellent way to achieve diversification. Secondly, index fund tracks a target benchmark or index rather than seeking for winners, so they avoid constantly buying and selling securities. As a result, the transaction costs are lower than actively managed funds. The efficient market hypothesis demonstrates that no active manager can base the market for long term, as their success is only a matter of chance, which is based on probability and luck. In longer term, passive management delivers better returns by theory. And finally, having a group of indices in your portfolio is easier to implement than a dynamic strategy that requires constant research and adjustments. So here comes the methodologies. With regard to the security selections in passive investing, I would like to select index funds such as SP 500, since they are relatively stable and have decent returns in long term. So to pick an index fund, my standards would be focus on long-term returns. In other words, I would focus on 10-year average total returns and expense ratio. I would like to choose 10-year average return between 10 to 15%, and on the other hand, the 10 to 15 return can hedge the inflation and cover some of my daily expenses in next 10 years. In addition, I would like to pick index fund with expense ratio lower than 0.05. For example, an index fund I've picked is called Admiral. The expense ratio is 0.04% and its minimum investment is $3,000. So in the next part, I would like to introduce the topic, allocation of alternative investment in COVID-19 pandemic. Alternative investments are generally considered to be any investment made in asset classes other than stocks, bonds, and cash. Alternative investment can include private equity or venture capital, hedge funds, commodities, and real estate. The public market has high volatility due to COVID-19 pandemic. Alternative investment can be a good way to diversify your portfolio and help you to reduce the risk to expose in the stock market. So another notable potential benefit of alternative investment is that your ability to invest using retirement account like your IRA is tax efficient, so it's quite beneficial for the elders. Hence, my suggestions would be, it is better to increase the proportion of alternative investments in the portfolio to reduce systematic risk and increase returns in COVID-19. So that's the end of my presentation. Thanks for listening. And here are the references I would like to acknowledge. Thanks for listening. That's the end.